easily lead to losing trades. But when the bias is clear, trading becomes much simpler, as it helps you make informed decisions with confidence. You know the market's likely direction, which allows you to focus on finding the best setups instead of second-guessing every trade. For those of you who don't know, daily bias is the directional outlook on where the market is likely to move during a single trading day. It represents the anticipated trend, whether bullish, bearish, or sideways, based on technical analysis and fundamental analysis. Let's start with the technical analysis. From the technical analysis perspective, determining a proper daily bias requires following key steps. These steps will help you analyze the market effectively and set a clear direction for the day. The first step is analyzing higher time frames. The first step before diving into any chart analysis is to focus on the daily or weekly time frames. This is because these higher time frames provide a broader view of the market, helping you stay aligned with the bigger picture and stay on the right side of the market. What we should do is identify the price's current dominant trend, whether it's in an uptrend, downtrend, or range-bound. This helps you understand the market's overall direction. Along with that, you'll need to highlight key support and resistance levels on these higher time frames. These levels act as critical points where price may reverse or break through, giving you important insights for your daily bias. Identifying these areas is critical because the market is fractal, meaning patterns repeat across different time frames. A minor reaction or shift on a higher time frame, like the daily or weekly, can lead to a significant change on lower time frames. Before placing any trade, we need to assess how much room we have before reaching a key level on the higher time frame. This understanding helps us determine where to set our profit targets and calculate the potential risk-to-reward ratio. By knowing these factors, we can make informed decisions about whether to open a position or not. The next step in the technical analysis for determining the daily bias is market structure mapping on the 4-hour or 1-hour time frame. Market structure mapping on the 4-hour or 1-hour time frame is one of the most important parts of technical analysis you'll ever do. Because once you get the hang of it, you can avoid common traps and make better trading decisions. The reason we chose the 1-hour and 4-hour time frames for market structure mapping is that these time frames are mid-range. They don't produce misleading information like lower time frames do, making their data more reliable and understandable. Additionally, they provide signals more promptly than higher time frames. What we need to do is check the 4-hour or 1-hour time frame general trend and determine if the price is in an uptrend, downtrend, or consolidation. This gives a more precise outlook for intraday bias. To do that, first, we should identify major highs and major lows. If the price is consistently making higher highs and higher lows on the chart, the market is in an uptrend. If the price is making lower highs and lower lows, the market is in a downtrend. If price is moving sideways with no clear structure, the market is in consolidation or ranging. After identifying the market's overall direction and major structural swing points on the chart, the next step is to look for breaks.
If your loan app has a low credit limit, delete it. If it offers a short repayment term,
And internal liquidity refers to the liquidity found within the current trading range, where most orders are actively being executed, such as order blocks, fair value gaps, volume imbalances, and trendline liquidity, which are formed inside the trading range. If you are looking for your daily bias, you need to know which way the market is likely to go, what your target is, and which zones have the potential to change the market direction. All of these steps must be done cleanly and straightforwardly. As mentioned before, the market always moves between external range liquidity, which is a high or low point, and internal range liquidity, which usually shows up as a fair value gap on the chart, and vice versa. To understand this better, if you look at this example, you can see that the price has pushed toward this external range liquidity above this swing high. After sweeping the external range liquidity, the price often pulls back down to address internal range liquidity, particularly in the form of a fair value gap. The market seeks to fill this gap as part of its natural rebalancing process. Once the fair value gap is filled and internal range liquidity has been addressed, the market looks outward again, seeking the next pool of external liquidity. This could be a new swing high. As you can see, the price went back up to take the external range liquidity, completing the cycle. If you're wondering how to apply this in your trading, or when finding the daily bias, using the concept of external and internal liquidity helps predict the market's next move easily. For example, in an uptrend, if the price respects a bullish fair value gap, it suggests the market is likely to continue upward toward buy-side external liquidity. However, if the price breaks through the fair value gap with strong bearish momentum, it signals a shift toward sell-side external liquidity, and a market structure shift could be on the way. So, to determine our daily bias, we need to identify both mitigated and fresh fair value gaps near the current price. This helps in reading price action more accurately. Now, let's move on to the second topic on the list: static liquidity. Static liquidity refers to areas in the market where liquidity remains relatively stable or concentrated over time, typically due to the presence of large resting orders, such as limit orders, stop-loss orders, or take-profit orders, that sit at key price levels. These areas act like magnets for the price, and the price tends to move toward them in the market. Identifying static liquidity areas is important for determining daily bias on the price chart, because smart money and market makers use these areas to fill their positions and move prices in their favor. By including static liquidity areas in your daily analysis, you can avoid getting trapped. There are many types of static liquidity, but to simplify the concept and create a clear roadmap for daily bias, let's focus on the most practical and main ones. The main types are equal lows and equal highs. Static liquidity often pools beneath equal lows or above equal highs, because many stop-loss orders are placed in these zones. These levels are targets for liquidity sweeps before the market moves in the opposite direction. Sell-side and buy-side liquidity. Above or below the major swing highs and lows. Similar to equal highs and lows, liquidity also accumulates just beyond swing highs and swing lows, where traders place stop orders. For example, within this range, this swing high represents buy-side liquidity that we could use as a future profit target. Dynamic trend lines and channels. Trend lines and price channels also attract liquidity. When price approaches the outer bounds of a dynamic trend line or channel, liquidity is often found just below or above these boundaries. The third topic on the list is liquidity sweeps. The next important step in determining daily bias is identifying recent liquidity sweeps near the current price. We should look for liquidity sweeps and stop hunts around key static liquidity areas, like major highs and lows, or key supply and demand zones. The core idea behind identifying liquidity sweeps in the daily bias is straightforward. When sell-side liquidity is cleared out through a liquidity sweep, the price often moves towards the buy-side liquidity and vice versa. So, this helps us to predict the price's next move in the market, especially on 30-minute, 1-hour, and 4-hour timeframes. The second reason is that liquidity sweeps add extra confirmation to our trades. The idea is simple. The market needs liquidity to build momentum. If the price doesn't sweep liquidity before hitting a key level, it often uses that area to gather the liquidity needed for its next move. For example, here we can see the price swept the buy-side liquidity above this major high with a body of a green candle, and then quickly closed below its range with the next candle. So, what does this mean for us? This indicates that since the buy-side liquidity has been taken, the price is more likely to move towards sell-side liquidity below the current price. If this aligns with the overall market direction, it signals a strong selling opportunity. However, if the liquidity sweep doesn't match the dominant trend, it still suggests.
Here's why you keep losing money as a trader. I'm about to give you a quick trading tip that flies in the face of what most
it signals a strong selling opportunity. However, if the liquidity sweep doesn't match the dominant trend, it still suggests a potential reversal, even if it's only temporary. We thoroughly discussed liquidity concepts in our previous episodes, so I'm going to put their links in the description box of this video in case some of you would like to watch them. Now let's move to the next concept in the technical analysis: identifying supply and demand zones. Identifying which side is in control in determining daily bias is crucial, because if you don't know whether buyers or sellers are controlling the market, there's a high probability you'll end up on the wrong side of the market. Now, how do we identify who's in control of the market? To see if demand or supply is in control, we need to check the 4-hour time frame and look at the most recent price origin. For example, if the price is in a downtrend and comes from a fresh, unmitigated supply zone, then supply is in control, and we should look for selling opportunities. Supply remains in control until the price hits a fresh demand zone and reverses upward. At that point, demand takes control, and we should stop looking for selling opportunities. So, identifying who's in control depends on how the price reacts to unmitigated supply and demand zones. Always remember that higher time frame fresh zones take priority over the time frame you're analyzing. This means, if the price hits a fresh, unmitigated zone from the opposite side on a higher time frame, it will shift control from supply to demand, or vice versa. Every time the price breaks through a demand or supply zone, a new zone forms on the opposite side, and one side loses control. For example, if the price breaks and closes above this supply zone, demand takes control, and a new demand zone forms. If the bullish movement continues and the price breaks structures to the upside, each demand zone becomes a new buying opportunity since our bias is bullish. This bullish bias stays until the price hits a fresh, unmitigated supply zone. Once the price reaches this zone, we no longer consider the market bullish, as it has the potential to reverse the price and cause a temporary correction. At this point, there's a battle between buyers and sellers, and the market might consolidate between supply and demand until one side takes control again. If the price breaks the most recent demand to the downside, it shows that supply has taken control, offering a selling opportunity. On the other hand, if the price breaks the supply zone to the upside, it indicates demand is in control, shifting the zone from supply to demand and giving a great chance to go long. Now that we've thoroughly covered all the concepts of technical analysis for determining daily bias with a simple step-by-step roadmap, let's briefly break down the fundamental analysis of daily bias. Fundamental analysis evaluates external factors such as economic data, news, and macroeconomic conditions to determine the daily bias. The first factor that needs to be considered is economic data releases. When it comes to economic data releases, these are the key reports that financial markets watch closely because they give important insights into the health of an economy. Let's break down a few of the most important ones: interest rate decisions, inflation reports, CPI, employment data, NFP. Interest rate decisions. This is where central banks, like the Federal Reserve in the US or the European Central Bank, announce changes to interest rates. Why is this important? Because interest rates affect the cost of borrowing money. Raising interest rates makes borrowing more expensive, which can slow down the economy, but also make the country's currency stronger because higher rates attract investors. Lowering interest rates has the opposite effect, making borrowing cheaper and encouraging spending, but it can weaken the currency. If the Federal Reserve raises rates, the US dollar often becomes stronger, making it more valuable compared to other currencies, leading to a bullish bias for the USD. Inflation reports, CPI. Inflation is all about how fast. The Consumer Price Index, CPI, is one of the main reports used to measure inflation. If prices are rising too fast, central banks may step in to control inflation by raising interest rates. If the CPI report shows that inflation is higher than expected, the market might expect the central bank to raise rates, leading to a bullish bias for the country's currency. Employment data, NFP. Employment data shows us how many jobs are being created or lost in an economy. One of the most watched reports is the Non-Farm Payrolls NFP report in the US. This report tells us how many jobs were added or lost in sectors other than farming. Strong job growth means more people are working, earning, and spending. This is good for the economy. Weak job growth or rising unemployment can be a sign of trouble, leading to a weaker currency or stock market. If the NFP report comes out stronger than expected, the US dollar might gain strength as it shows the economy is doing well, leading to a bullish bias for the USD. That's it, traders. Thank you for watching this video. I hope you found it informative and useful.